Good day and welcome. Today's date is Thursday, the 2nd of April 2020. In this video, we're going to discuss multiple facets of the United States economy, each of which is going to indicate economic weakness, or if not direct weakness, problems within the US economy that will have a cascading effect over time. The slides are going to be timed to around about 15 seconds each. I'm not going to read the text out in the slides, so please feel free to pause the slides so that you can read the text, which indicate highs and lows over a particular period. So I'm going to rush through the slides as fast as possible, just to give everyone an indication as to where this thing's going. Looking at GDP in any country, but here specifically the United States, two substantial components to GDP are really important. That is household or individual spending and government spending. In the United States, as you'll see on some of the slides, savings has gone through the floor. Salaries haven't increased substantially or in a meaningful way over many, many years. So how does the government encourage GDP figures upward? They do that by encouraging debt. So households and individuals take on debt and the GDP figures look good. It's good for GDP, but it's not really good for individuals who take on such levels of debt that they find that just paying back the interest is problematic and they're borderline. As I showed in one of my previous videos, the Federal Reserve Report on Household Weakness. If you have a look at that video, you'll understand precisely what I mean. The US has many overseas military bases that cost a massive amount of money, billions or trillions of US dollars. That's also good for GDP because government expenditure is a component of GDP. The 36 odd graphs or slides that are going to follow will give you a very good indication as to the nature of the underlying problem. Now, when a building is built on foundations that are not sound or flawed foundations, any number of events can bring that building down. A minor earthquake, a severe storm, massive rains, a whole host of natural events can cause that building to collapse. The fact that the building is going to collapse on the basis that it is built on unsound foundations is a given. It will happen. How it's going to happen and when it's going to happen is up to debate. It's an uncertain situation. When you have a look at the US economy and the underlying weakness in the US economy and the way that the stock exchange is manipulated, you're looking at a flawed foundation. And some event at some point in the future is going to bring that flaw out and is going to put the entire situation, the entire economy at risk. In this case, people will be blaming CV19. Perhaps that's a valid point. However, CV19 didn't cause Saudi Arabia and Russia to bring about the collapse in the oil price. CV19 had nothing to do with it. If you have a look at Deutsche Bank had nothing to do with CV19. If you have a look at the trauma that HSBC is facing, that had nothing to do with CV19. If you have a look at the repo market problem, starting in about the 17th of September 2019, that was before CV19. So these on their own or combined are sufficient to create substantial stress, which might in turn, depending on where they go, create some form of economic trauma or economic collapse. In this case, however, CV19, the lockdown, business closures, mass layoffs have been the trigger. But don't forget that underlying CV19 is Deutsche Bank, is the repo problem, is the oil crisis, is HSBC, and that's to name but a few. So please stick with me. This is a story that you don't want to leave half read. Let's go right the way through to the end so that you can understand exactly what the situation is, how the graphs show what the problem is across many components, many aspects of the economy. And we'll have a brief summary at the end of that. Again, please stick around. This really is important for a deeper understanding into economic weakness and how the US economic foundation is flawed. Where it's going to go from here, nobody knows. Some people are saying a 29 type depression. Other people are saying a severe recession. The judge is out. This is a graph taken of the overall US stock market on the 7th of February 2020. You can see exponential growth that was stimulated by share buybacks and by cheap money put into the economy, placed, or liquidity into the economy by the Federal Reserve. Here is the NASDAQ Composite Index graph taken on the 18th of February 2020 showing exponential growth. This is the S&P 500 index taken 18 February 2020. Again, you can see it going through the roof. Dow Jones Industrial Average taken on the 18th of February 2020. Like all the other graphs, this indicates an exponential climb. The United States federal corporate tax rate cut, as you can see by the graph going downwards. This has not helped the man in the street. This has helped corporates and assisted in corporate share buybacks. It has also reduced revenue from corporate taxes going into government, which could in turn potentially go into infrastructure development and infrastructure repairs and maintenance. Bizarrely enough, United States consumer sentiment is on an upward climb, despite the fact of economic underlying weakness. I can only assume that this optimism is a result of listening to mainstream media and the President of the United States saying that everything's cool, everything's rosy, everything's fine, don't worry about it. This defies the reality of the situation. The US has always prided itself in car production and farming. In this graph, you can see that motor vehicle production is on a downward spiral, and if this continues, it'll go to zero. To support the previous graph, you can see that new passenger car registrations is on a slippery slope downwards. This could indicate that people just don't have the money for new cars. Alternatively, it could be as a result of new car production going down, or people relying more on public transport, or a combination of all these. You can see by this graph that farm sector debt is getting out of hand, combined with the fact that export markets are taking strain. This is an unacceptable situation for US farm produce. Look at what's happening to grain. This graph is self-explanatory. US chain store sales are on a slippery slope downwards. This could be as a result of internet purchasing or online purchasing. Alternatively, it could be a deeper symptom of a lack of money in the population in general. The 30-year mortgage rate is coming down. One would assume that with reducing mortgage rates, that would boost house sales. However, what is to follow will indicate that this is not boosting house sales. There's a systemic problem here. The home ownership rate has been dropping systematically over a number of years, with an uptick in the last couple. According to the Case-Shiller Home Price Index, house prices are on a steady increase. This could be entering serious bubble territory and a lack of affordability for the majority of the population. Wages and salaries growth over the last many years has been absolutely appalling. And while people's income is steadily dropping or remaining under the inflation rate, the US stock exchange is going through the roof. Consumer spending continues to increase. The question is, where is this money coming from? If it's not coming from salaries or savings, it must be coming from credit. US private consumption expenditure is going through the roof. Don't worry, people. Spend as much as you can for as long as you can. Since the 1970s, United States personal saving rate has been declining. This is a serious underlying problem. Since just after 2013, US household debt is increasing radically. Domestic credit is at an all-time high. This obviously reflects back on consumer spending. Likewise, if there are no savings, spending must come from credit. This graph proves it. US manufacturing PMI is hovering around all-time lows. Despite a recent uptick, this situation is going to change radically as a result of CV19. Despite that, it is not looking good anyway. The composite PMI isn't doing well either. This is an economic slowdown in the making. Since 2010, the labor force participation rate has not been doing very well. Productive capacity is on a decline. Have a look at the capacity utilization here. It's on a downward slope, and if this trend continues, it's not going to get any better. This slide is talking about M1 and M2 money. It needs to be read if you want to understand what M1 and M2 money means, because what follows this is going to be the graphs on M1 and M2 money, as well as the velocity of M1 and M2. And those graphs are important. I won't be reading this for anybody, but please feel free to pause the video and have a read. US M1 money supply, like everything else, climbing. M2 money supply, like M1, climbing. The velocity of money roughly indicates how many times, for example, $1 changes hands over a given time. The less the money changes hands, the worse the money velocity is. That means as velocity reduces, money isn't changing hands. So while money isn't changing hands on High Street, look what's happening on Wall Street. Reduced M1 and M2 money velocity is a clear indicator that things aren't going well on Main Street. Please read the text above the graphs to establish the difference between M1 and M2 money stock. M2 velocity, just like M1, is going through the floor. Government debt is hitting all-time highs. This is post-CV19. This graph in March and April is going to change substantially, and it is going to go vertical. Government consumption expenditure yearly is doing what all the other debt-related graphs are doing. It's climbing. In the 60s and 70s, United States loans and leases in bank credit were plodding along quite nicely. In recent times, they have grown drastically. US commercial and industrial loans, likewise, are going through the roof. Private individuals and corporations are becoming more and more indebted. This is the United States bank's balance sheet, not the Federal Reserve balance sheet, but the balance sheet of banks. Look where it's going. United States external debt, climbing. United States foreign exchange reserves are low. This is not a good sign. Since 2010, they've been steadily declining. US gross federal debt to GDP is almost as ugly as it was just after the Second World War. This graph during March and April is going to go vertical. If the US isn't careful, it's going to be competing with Japan. Thank you for coming this far and having a look at these graphs. I hope that they've given you an understanding as to the underlying flaws in the foundation of the US economy. There's a clear indication that the Federal Reserve is pumping massive liquidity into the market, and that liquidity is not reaching the man in the street. That liquidity is, and probably will in the future, look after corporates and corporate interests at the expense of the factors of production, the people that actually use their hands and brains to work and to make things happen. It's the population who suffers from the abuse of corporates and the abuse of bailouts. And this is seen by the opioid crisis and by homelessness in mainly coastal cities and the associated devastation of households. If you like this video, please share it, like it, ding the bell, and subscribe to our channel to have a look at future and previous videos. Thank you. Bye-bye.